Financial literacy makes all the difference in the world. So I'm not here to turn you into nerds, like wearing green shades, doing like debits and credits in the back office, right? That's not what I'm about. I'm here to teach you just the story behind the numbers, and this is a short course. To kick things off, right, here's one of the first formulas that you're gonna need to know in your business. So if we look at this formula right here, free cash flow equals weighted average cost of capital minus growth divided by your returns to the x third power. This is something you're going to want to write down. No, I'm just kidding. You guys are like, oh my gosh, this is intense. No, actually, it's not going to be like that at all. So what we're going to do first is I'm going to have you write down on a piece of paper, just one of these legal pads, write down like what's the one thing or two things or three things, like what do you want answered? I know if I ask the group, if I say, hey, you know, what do you want answered in this session? Then, you know, a lot of you may be shy. You're like, I don't want to write down like my business is out of cash, or like we're struggling with like, you know, a decline in sales, whatever it may be. You can write down anything, right? So write that down on a piece of paper and then fold it up or whatever, or hand it in. And I'm going to keep it discreet. So I'm not going to be like, oh, and you know, da-da-da said. Okay, is that fair? All right. So any question you want to ask, it could be about business strategy, it could be about finance, it could be about sales, whatever it is related to business, feel free to ask. This is your opportunity to ask a CFO. Whatever you want. If you don't have a question, that's fine. If you want to know why I'm bald, you can write that down on a piece of paper too. And then when you're done, Morgan will come. Morgan works with me. She'll come around and grab them. Just hold them up when you're ready. Morgan, you collect those. Okay, after you're done with the question, can you do me a favor? Can you just rip off one of these pieces of paper and then on it, write your name really big and just put it flat on your table so I can see your name. Here's, you write on that marker there. Here's a big fat marker for you right here for your name. Just write it on the piece of paper really big so if I like look over, I'm like, okay, that's Courtney. Thank you. Yep, you just put it right down, flat, so I can see it. Great. Thanks, Michael. And how do you say that? Lupe? Lupe. Awesome. Drew?
Michelle.
Michelle? Okay. Courtney. Oh, that's a unique name. I've never seen it written like that. That's cool. Thank you. Shandi, is that how you say it? Shandi? Okay. Shalom. Need a big marker? There's that. Where are the other markers? Let me grab that. Who else needs a big fatty here?
Do I put my name on it?
Yeah, just so I can see it. Just write it really big. Get that? Okay, thanks. You like my eraser? That's great. It's high class. Yeah, super pro. Okay, Stuart, Alex, Doug, Kenneth, Doris. Okay, you might have to write that down. So, is that on your paper? Just write Doris somewhere. I'll probably remember that, but just in case. And then Kristen. Okay, we're good. All right. Everybody's good with their questions?
I want to know what your question is.
You're like, oh, you're like, stop bossing me around. Jeez. Okay. So first of all, I'm super grateful for this opportunity to do this. So thank you, Derek, for all the hard work of getting everybody here. Matt, thanks for the opportunity to do this as well. I'm really excited about this. So I love finance. My whole background's like in accounting and finance. So I did my undergraduate in accounting, did my master's in accounting, got my CPA, went and got my master's in finance and international strategy. And I built a business back in 2009 to help companies to take their strategy, right, their business strategy, and their money and tie those two things together. Because otherwise businesses are just like, okay, here's our mission, vision, values, and like we want to do this and this and that. And then they leave and it's like, oh crap, well how much cash are you gonna need? Like what's the return on that? Like what are your margins? And what's the story behind the numbers? And then there's this like massive gap. So it's like, okay, let me fix this gap by connecting a company's mission and their money together, and that's what I do. So I've been working with Family Jones for a while now. I also work with Little Man up the street, and it's just such a great opportunity to be here. So I'm pretty like chill, okay? Now you are all experts in your own domain, and like you have expertise that I don't have, and then I may have some expertise that you don't have, so we can just like feed off that. Is that cool? We could be just like vulnerable with each other. So I don't expect you to come in here with any financial, accounting, strategy type of acumen. So we're just like all starting from baseline. And then in return, don't expect me to know like how to run a restaurant or a bar down to like the details. Okay, is that fair? So how many of you, or let's just go around real quick and let's just say like, who do you work for? What's your role? And go from there. Just real quick, starting with you, Lupe.
My name's Lupe. I am the taproom operations manager down in Colorado Springs for Red Lake Brewing. We've been a brewery for about 11 years, but we've been at our big facility for about 3. And I've been in my position for about 10 months now.
Perfect.
But I've been in restaurant for 15 years.
Okay.
My name is Michael. I have a bar downtown Colorado Springs as well. It's called Chiba, and I own it. And I've been in the restaurant industry for about 110 years.
Nice. Okay. Shandi.
I'm Shandi. My husband and I own the Warehouse Restaurant in Colorado Springs, and I run front of the house, office, that kind of thing, and he is the chef.
Perfect.
My name is Drew. I run the Crow's Nest at the South Broadway Country Club on Tennyson Street. I've been in that position for about a year, but I've been in bar and restaurant management for about a total of 10 years, and in restaurants and bars in general for about 25.
Nice.
My name's Michelle. I'm with Sinners and Saints in Castle Rock. I own that with another friend of ours, and also have a couple small restaurant concepts in this food hall that also houses Sinners and Saints.
Awesome. Welcome.
My
Courtney.
name's Courtney, and I own the Universal. My husband and I own the Universal as well as the Highlands here in Northwest Denver. Universal's been around for 12 years, and the bar, the Highlands, is about 8 years now.
Okay. Welcome. Alex?
I'm Alex. I've worked in hospitality for 17 years. Right now I don't work in service. I run a company called Focus on Health that does advocacy work for the industry for well-being. And my husband and I are opening a new bar in the coming few months or so.
Okay.
TBD.
My name's Stuart. I own with a couple of business partners, Curio in the Denver Central Market and Rogers in the Edgewater Market. We previously had a bar downtown called Brass Tacks. We closed towards the end of COVID. Been in restaurants for about 20 years, both front end, back of house, and lots of management and that sort of thing. And yeah, now opening another one.
Awesome. Great.
Cool. My name's Kenneth. I'm the chef and owner of MacFam. Been in restaurants my entire life. My parents owned a little Chinese takeout spot, so I was a restaurant kid growing up. Moved to New York City in 2010 to pursue cooking professionally. I've been cooking ever since.
Okay. Great.
Doris, I'm his wife, also the owner of MacFam. I'm the GM, and I run the front of house operations. Been in the industry for 5 years. Prior to that, I worked for startups as an operations manager.
Awesome. Great. Okay.
My name is Doug. I'm in my 15th year in hospitality, first year as a beverage director for Edible Beans.
Great. Welcome. Kristen?
I work for Stewart, bar manager at Rogers Liquor Releases.
Okay, great. All right, well, welcome. So where are you at on like a financial literacy scale? Dude, this is like, I'm an expert, and you're like, Steve, I could actually teach this course, to this is like, I know nothing about finance and accounting concepts. Show me the gauge. Okay, cool. So when I was 16 years old, I left home. I moved in with my sister, and from her garage, I started my first company as a landscape design build firm. I was working at Dairy Queen, making $4.25 an hour, and I was like, this is ridiculous. So I decided to do my own thing, and it was supposed to just be like a summer job. But I was like, oh, I could charge $50 an hour, plus I could charge for my parts, market my parts double, and this is like way better than $4 an hour. So I did that, and then it grew into a multi-million-dollar business. I did that into my 30s. And when I look back on those landscaping days, I had no clue how to read financial statements, like at all. I had no clue. Like I had an accountant, and she would do my books, and she'd give me the income statement, and I look at it and be like, okay, sales, I get profit. But if you were to say to me, hey, your gross profit is declining, what are 4 ways to improve that? I'd be like, I don't know, just like go do more bids, like go do more work. I don't know, right? Like raise our prices, but how much do we raise our prices before we start losing customers? And I was just like winging it. And I left a ton of money on the table. I made a ton of mistakes. And so from that experience, I realized like, oh my gosh, financial literacy makes all the difference in the world. So I'm not here to turn you into nerds, like wearing green shades, doing like debits and credits in the back office, right? That's not what I'm about. I'm here to teach you just the story behind the numbers. And this is a short course. We're going to do like a little hour or so deep dive and teach you the fundamentals. And then the afternoon is going to be more like Q&A, like during lunch, after lunch, right? So we have a short period of time together. I have no agenda. It's not like I have like this scripted course to teach. Really, I'm here to do it on the fly because I want to help you guys. Like when you leave here, I want you to be like, okay, I got like 1, 2, 3 things that I'm going to go and implement in my business to drive sales, to drive revenue, to drive profit, cash flow, whatever it may be. Is that fair? Okay. All right, so hopefully I'm not too intimidating. My browser just loaded by birth. I'm not that scary of a person, even though I'm bald. Okay, so just feel free to interrupt me at any point. Just be like, hey, Steve, question on that, or like, you're going way too deep, too nerdy, and I'll stop and I'll explain. Fair? Okay, so let me ask you a question. So we have 2 companies. We have company A and we have company B. And let's just say company A, we'll call company A Old Fashioned Co. All right? And what they do here is they just sell old fashions to their customers. That's it. They have no other product, hypothetically, right? That's all they do. They just sell that. And then over here, do you guys have another favorite drink of choice?
Daiquiri.
Okay, this is called, can't even spell, DAC Incorporated. Okay. I like DAQZ. Okay. So we have Old Fashioned and Daiquiri Incorporated. All right. And let's just say that this company, Old Fashioned, they earned a 60% margin on their product. Okay, gross profit. And then Daiquiri Incorporated, let's just say they earn a 80% margin on their product. Which company would you rather have? Which company would you rather own?
That's a trick question. Sounds like a trick.
Depends on volume.
Say it again.
Volume depends on volume.
Yeah, it depends on volume, right? So that's what we're going to talk about, because here, sure, you can earn 80% margins and you can still go out of business, right? And it's all because of volume, and it's really what I call throughput. Throughput is how fast you're turning transactions, because margin doesn't really matter a whole lot. When I was in the construction industry, like I went out to Chattanooga and I turned around a $1 billion business.
That's where I'm from.
Chattanooga, yeah. Okay, yeah. That's funny, small world. So there's a construction company out there. They're doing $1 billion a year in revenue, and for the first time in 50 years, they were in the red. They brought me out to turn them around, and we were looking at all the jobs, and we would look at the different projects, and it's like, okay, all the projects are profitable. Like, what the heck? Like, we have profit margin on all of them. Like, why are we like losing so much money? And the reason why is because our throughput. So if you think about like a healthcare facility, we would build these buildings and it would take forever to close them out. because like, okay, now we got to go back and do this, we got to do that, and they just drag on forever. So sure, we had earned the profit, but it would take so long to earn the profit that it was like we were burning through overhead, and therefore we weren't making money at the end of the day. So that's where I want you to be careful when we talk about like margin. Oftentimes people are like, oh yeah, like I earn like 50% margin. It's like, okay, that's great. That means nothing to me because you can still go out of business with that. Okay, so that's a really important concept to understand here. Now let's get into, let me set this up even further, and let's talk about how do you actually calculate gross profit. All right, so let's just look at old-fashioned company right here. Here's my cup, and at the bottom here we have ingredients. We have the orange peel, the bitters, the sugar, right? Everything that goes into it, and then we have the whiskey up top here. Okay, and let's say the whiskey is $2.50, okay, per serving, and these other ingredients are 50 cents. All right, so we have, let's say, a material cost of $3. Right? What are we missing in this equation right here when it comes to calculating gross profit? We have the cost of the materials.
Labor.
The labor, right?
Utilities.
Whatever
Yep.
you're paying in an ice machine and maintenance and
Yep.
glassware and
Yeah.
tools. And
So let's talk about how to frame gross profit so we're all on the same page, like what that actually means. If you look at an income statement here, the income statement's broken down into 3 sections, right? So the first section up here is revenue. If my handwriting's terrible and you can't read it, like just tell me, I'll explain. So we have revenue up here. So what is revenue?
So money you bring in.
Yeah, it's sales. Like you swipe a credit card, you collect cash, you sell a product, you hand them the plate, you hand them the glass, whatever it is, you just earn revenue, right? Then underneath here we have COGS, cost of goods sold. What are COGS?
The things that we're buying to generate the product.
Yeah, so it's all the costs associated with fulfilling the revenue. So it's also known as cost of revenue. It's like your cost of revenue. Or if we called this sales, revenue sales, same thing, right? Then it's your cost of your sales. So if you think about it, what goes into cost of goods sold in a restaurant?
Materials.
So materials, right? Materials, supplies. What else? What's that?
Labor.
What kind of labor?
The time it takes to make the product.
Yeah, so anybody who's involved with delivering the product or service to the end user goes up in cost of goods sold. And so it's a little gray, but not really. I mean, I just say like it's anybody who's involved with the fulfillment of the product or the service is in cost of goods sold.
What about like batching stuff? Like say you have somebody here making cocktails for 3 hours.
Yep.
That should be involved in that.
Yeah, so like all the batching, all the prep, everything is going up here because they're only doing that because you're gonna, deliver it to the end user, to the customer, right?
Well, what's the exception?
Sorry, so COGS is only for when it comes to labor, people who have their hands touching the item that's being sold.
Yep.
So not like the servers who are serving that item or some other person that's taking the order.
The servers would be up here too because they're involved in the whole process. Now the exception is, so what if you have an accountant on staff, a bookkeeper? They're a W-2 employee, where do they land?
That's not bad.
Yeah, so they're landing down here because you're doing accounting no matter what to run the business. They're not associated with fulfilling that product or service. So that's really important to understand. We'll get into this here in a minute, a little bit more. So we have materials, labor, what other types of things would end up in cost of goods sold?
Rent and utilities.
So rent and utilities would go actually down here, and I'll just abbreviate OPEX. That stands for operating expenses. SG&A, selling general and administrative, or overhead, or fixed cost. They're all synonymous. It's all OPEX.
Well, I don't know what's included in materials, but you've got your products, you've got your serving glassware, as someone said earlier,
Yep.
you've got your straws. I mean, the list can be really endless in terms of that final product.
Yeah, let's just assume all that. What about like uniforms? Where would uniforms go? So uniforms, the only reason why you have uniforms is because you're delivering a product or service. Otherwise, you're not just like buying uniforms to buy uniforms. So that's kind of how I like to look at things, is like anything associated with fulfilling this product. Napkins, paper goods, uniforms, tablecloths, whatever it is going to go up here in cost of goods sold. OpEx, this is going to include your general and administrative payroll. So your accountant, your marketing person, your, whoever is involved is running the business overall, but they're not fulfilling the product or service. Okay, you have rent. You have sales, marketing cost. Utilities. Okay, yeah, this is where we get into some nuances here. So credit card fees, like merchant fees, where do those go? Yeah, cost of goods sold, because you wouldn't have the merchant fee unless you're selling a product. Like if all sales stopped, like, okay, shut down your business and you still have to pay your rent, you still have to pay your bookkeeper, you still have to pay the utilities. Would you pay merchant fees? No, you wouldn't, because you're not swiping cards. So that's where it gets a little like gray. But if you just keep thinking about that, keep asking yourself that, merchant fees would go up here. Here's another thing that I often run into is insurance. Let's talk about insurance. Insurance is going to be broken down into GL insurance, general liability, and then you have workers' comp. So what do you do with insurance? So the same thing is true with like workers' comp. Think about workers' comp. Have you ever been audited? Like every year you get audited typically by your insurance company. And so what are they basing the audit on? They're basing it on thousands of payroll, right? So it's driven by payroll. So therefore, workers' comp is really a part of labor. It's a labor burden item. So this is where I like to break out workers' comp and put it up in my COGS. Otherwise, you're misstating your gross profit. General liability on your building, whatever, like that's going to go down here in OpEx because you're not paying GL, general liability insurance, based on your labor. Does that make sense? Okay. So in this world, so like when I go, like I'll go work with companies and they'll come to me and they're like, hey, Steve, help me like be more profitable, help us turn around, whatever, help us grow. One of the first things I do is I pull their financial statements. A lot of times they're in QuickBooks or Xero or some variation thereof, restaurant, R365, whatever. And so I'll pull the statements there and I'll look at the general ledger. And what I find is that it's a freaking mess because they have labor. All the labor typically is down here because they just have one payroll service and then they take all that payroll and they just like record it all to OpEx. And I'm like, there's no labor up here. And then like uniforms are down here, you got insurance down here, merchant fees are in OpEx. And then when it comes to looking at their pricing and their gross margin, they're like, we're killing it. We're making like a 75% margin. And I'm like, okay, well when you add in this and you add in that and you add in this, you're actually at 35%. Changes the story quite a bit. So accountants hate me, even though I'm a CPA. It's like, hey, I'm one of you. Like, you should like me. But they hate me because they get so territorial on their chart of accounts, like all their accounts. They're like, I do this for tax purposes. That's what I just got last week. The CPA is like hating on me because he's like, I do this for, it makes things easier for me when I do their taxes. I'm like, well, that's great that it's easy on you, but I'm trying to reorganize the financial statements to show the economic reality of the business, to make the business owners and the managers more informed on how to run a business. So just be careful of this. After you leave here today, make sure that your financial statements reflect the true economics of your business. Otherwise, you're not going to understand the story behind the numbers. Does that make sense? You're going to be totally skewed. Okay. Income statement. Revenue, cost of goods sold. Right after cost of goods sold, this is where we have gross profit. Gross profit, gross margin, same thing. Gross, just think of it like that. And then you take out OpEx, and this is where you end up with operating income, operating profit. Now, where does PPP money go? ERC stuff, any government incentive money, where does that go in here?
Well, if you have to pay it back, it's a liability.
It's liability, so it's sitting on the balance sheet. If you don't have to pay it back, it shows up as other income. And so down here, you have this other income and expense that is non-operating. So like when I say operating profit, this is how much profit you earn from normal operations of your business. So if you sell a piece of equipment, you're like, okay, we're gonna sell this this range or whatever. We're gonna sell this fridge, and you get money from that, and you show a gain. You're not showing it up here, unless you're in the business of like refurbishing your appliances and selling them. That's gonna come down here in other. Interest expenses down here because you're not a bank. You're not in the business of paying interest. Interest income, if you're earning interest income, it's going down here. All other non-operating stuff, one-off stuff, goes down here. You get insurance money from a claim, whatever it is, all other. Cool? So we're not going to really talk about other because I want to focus today on operating income, like just your core operations. Okay, cool? So what's gross profit then? Gross profit is essentially revenue minus cost of goods sold. It's your profit before overhead. Fair? Okay. So why is gross profit important? The reason why gross profit is important because, number one, when it comes to pricing your products and services, you need to understand what your gross profit is, your actual gross profit. Okay, otherwise your pricing is going to be all screwed up. The second thing is you want to figure out what your break-even revenue is. That's going to be really important too. Okay? So let's write down some numbers on your pads. And if you don't know any of these, just make them up. Just guess, okay? So when it comes to like accounting and finance, like obviously I'm very precise. I have to be very precise with certain things. But I'm kind of an anomaly out there in the world because like most CPs are like, nope, we have to like tick and tie it. I need this like $8 receipt before I close the books. I'm like, close the books, you know? It's $8. We don't care, right? So like when it comes to numbers, just think high level with me today. If you're like, I don't know, is it like 32 or like 33? Like who cares, right? It's 30. Just say it's 30, right? Okay. So here are a couple things that we want to do. Let's first figure out all the people that touch the product. Okay, not the people in the back kitchen cooking or prepping. That's a different conversation. We're switching gears now. Okay, this is not a cost of goods sold conversation. I want to talk about the people that actually hand the plate or the drink or whatever it is to the customer.
So front of the house folks.
Front of the house folks. Okay, how many people do you have and how many hours do they work per week? So front of the house, I may say, okay, I have this business and I have these two servers and they work 40 hours a week. Then I have 80 hours right here.
Are front of house managers included or are those just hours?
Nope, just the people that are like actually serving the food or the product. Okay, then you could count them, yeah. But don't double count. Don't double count somebody like in the kitchen. I'm just talking about like the person who's like, here you go, here's your plate, here's your drink.
And then support staff, like bussers.
Yep, don't count them. Don't count them in this.
Now for hours, do you want the total per week?
Yep, total per week.
For admin.
Yep, everybody who's touching it and like giving it to them.
Try to remember 5 years ago.
They're all the same.
Yeah, pretty simple.
Yeah.
Yours is simple, so how many do you have?
I mean, I said 10 and they all work like 30 hours, so 300 hours.
300 hours, so you have 300 hours, okay. So like in the ice cream business, so just give you an example of the ice cream business, we count people that are actually scooping the ice cream. Hi, can I take your order? I want chocolate. Scoop, waffle cone, hand it to you. The person who may be in the back is like, hey, I wipe the counters and I go fill the freezers. Like, we're not counting that person. We're just talking the person who's delivering the product to the customer. Okay, so you got that number right here? All right, so those are your number of hours. Now, what I want you to do is think about your overhead cost, your OPEX. You can look at it on a monthly basis if that's easier, or an annual basis. But how much does it cost to run your business? You do a month, and then we're going to extrapolate this per year. So you do per month if you
So
want.
you're talking about OPEX.
OPEX, yep.
So rent, utilities.
Yep, rent, utilities. And if you're running the business, here's the other thing that I forgot to say. When it comes to OPEX, like if you're running the business, how many of you own your own business? Okay, how many of you are an LLC? Okay, are you taxed as an S corporation, or are you an LLC taxed as a partnership? Or are you like, I don't know, partnership? Okay, so as an LLC, remember LLCs and S corporations don't pay taxes. Those entities do not pay taxes. The income flows to the owner, and the owner pays taxes, but the business itself does not pay income tax, okay? LLCs, that money flows right through to your K1, and you pay based on the distributions. So you have to include your replacement cost in the OPEX. Even if you're not paying yourself what you should be, you have to include what would you have to pay somebody to take your position. I was working with a business recently, and when I looked at their numbers, they're like, yeah, look at our profit margin. It's like 25% bottom line. And I'm like, yeah, because your salary's not in there. Like to replace you, you'd have to pay somebody $150,000 as a general manager just to run your operations. And that radically changes the number. Okay, does anybody want to share that number with me? If not, it's fine, I'll make it up. How much?
So that's just to show the more truer, closer profit.
Like the economics, yeah.
Right, like if you were wanting to sell the business or something like that, so people could be like, oh yeah, you're not paying a general manager.
Yep.
Okay.
It's that, and like, so you say, okay, it costs me $500,000 to run my business a year for rent, utilities, sales and marketing, all that stuff. And you're like, and we make a 10% profit. And so when I look around, like 10% is good. So like, I'm good. I don't need to raise my prices. I don't need to improve my business. But then going back to Derek's question, it's like, yeah, but like if you die or get hit by a bus and you want your business to keep going, like for your partner's sake, your spouse's sake, your kid's sake, whatever, you're gonna have to go hire somebody to go run your business. So now go hire them, and it's like, well, I can't hire them. We don't have the money. Otherwise, we'd be negative profit. It's like, yeah, see, your business isn't economically viable. That's the whole point. So you need to, like, all you business owners in here, you need to like step out of your business for a minute and like look at your business as if you're an investor. Like take yourself out of it, like step out, right? Zoom out and look down and be like, would I be cool with investing in this business the way it's running right now? And if you're like, no freaking way, I would not be okay with that. That's how you got to look at it. Okay? All right. So anybody want to share, or you want me to just put up an example here?
Can you do an example? Just do an example.
Yeah. So if I say, let's just say my G&A salaries. So my payroll, let's say I pay $250,000 a year. Okay. Then sales and marketing for social media, sales and marketing, print stuff. Let's say I spend $50,000 a year. And then rent, utilities. Let's just say I spend another, I'll just say $50,000 a year. And then insurance, spend $20,000 a year, and then miscellaneous stuff, I spend $30,000. General and administrative payroll, just like the people who are non-back of house, front out, they're running the operations of the business. Okay, general manager, right? Okay, so we have 300, 400 G's to operate my business. Okay. Now, I don't know if you guys know this off the top of your head. If you don't, that's fine. But you say, what's our gross profit on this? Like, what's our gross profit in the business? So if you know your gross profit, great. If you don't, that's fine. That's homework. You go do that and figure it out in your business. But gross profit, I'm basically just taking this as a percentage of my revenue. My cost of goods sold as a percentage of revenue. Okay? My gross profit, not cost of goods sold. Steve, total rookie. Gross profit as a percentage of revenue. Okay? And let's just say in my business, my gross profit equals 45%. Now it ranges per business, per location, per size, per product mix, but I would just say a general rule of thumb is gross profit is usually around like 40 to like 60% on the high end. Good.
You said 45 to 60%, but how do you get that percentage?
So you just take your gross profit that you earn and then divide that by your revenue, by your total sales.
Okay.
Yep. Okay, so let's just say my business does $1,000 a year. My cost of goods sold are $550. That leaves me with $450 in gross profit before my overhead. I just take this $450 divided by 1,000. It gives me 45%. Cool. I said it varies because I work with a company and they have like 30% margins, but their overhead is like super slim. They just run a super lean operating expenses, and they make like 12% profit, bottom line. But I also know companies that have like a 50% gross profit and their overhead is so stacked, they just have all this stuff in their overhead. Like their cost structure is really high and they make like no money. So it varies, okay? But let's just say for my business, it's 45%. To figure out break even, this is where you should just you could just use my gross profit if you don't know. To figure out your break even, you're going to take your operating expense, so it's OPEX, divided by your gross profit percentage. Okay. So what is that? I don't have my phone on me. 400 divided by 0.45. Will somebody do that for me?
400,000.
Yeah. Yep.
$888,888.
$888,888.
0.889.
So we'll save that for the nerds and birds. We'll just round up. 888K a year. What's this number mean to you?
That's your break even?
Yep. This is my break even. So this is how much revenue I need to do per year to make zero profit, to not lose any money. Okay. What's interesting though, like, and we'll talk about this today, like the whole thing, like I'm so much more of a growth guy than a cut guy. Like a lot of people will go into companies, they try to fix them, they cut. So they're just like, let me see your payroll. And they look at their payroll summary and they're like, why is this guy making this much? Fire that person. And it's like, yeah, you fire that person, but they make all the magic happen in the business, right? Or they're like, oh, here, let's go back to our vendors and like beat them up on their cost, right? So we're gonna go back to our suppliers and be like, drop this, give us discounts here. And it's like, great, you do that short term. And guess what? Your suppliers are not gonna be there for you when you need them. So like, terrible idea, long term. So instead, if you can grow your business, which we'll talk about, then it makes all the difference in the world. Like if you can grow your gross profit, do the same math for me, but just take, let's just say you increase it to 45 to 50%. 50% divided by 400 is what, 800, right?
So you knock off, you raise it by 5%, you knock off almost $100,000.
Yep.
To get to the break even.
Exactly, and think about that, $100,000. $100,000, like 100,000, what's 100,000 divided by 15? What is that? Somebody do that math? Sorry, I don't have my calculator, so I don't want to hurt my head today.
6,666.
6,000 drinks you have to sell, cocktails.
That's a cheap cocktail.
That's a cheap cocktail. So how much is it, like how much are cocktails selling for? $20? I don't know. I don't drink, so
5,550.
5,500 drinks you have to sell just because you don't fix your business. You're just like, I'm just gonna keep grinding away. Like, I'm so busy right now, I can't fix my business. I'm just gonna go serve 5,000 more drinks because I'm not fixing my business. Right? So that we do weird crap. So anyways, that's the whole thing. That's how break even works. So if we say, this is my break even, this 888 right here, let's just run with this. And let's say I have 2 employees who are serving, and they're working 80 hours a week, and then I multiply that by, just say 52, or let's just do it by 50, right? Give them 2 weeks off a year. Then 80 times 50 is 400, right? And then 400 divided by this number right here will give you your revenue per hour, your sales per hour that they have to do. So that's the second thing you need to do. So the first thing is you need to organize your financial statements in a way where you can understand the true economics of your business. That's step number one. So get everything up in cost of goods sold that belongs up in cost of goods sold. Move everything in OpEx that you need to move in OpEx, and then figure out your gross profit. That's step one. Step two is figure out how much revenue or sales do your employees have to do, the ones that are touching the product. That's why we don't include like back of house, because otherwise you go to like your chef and you're like, hey, your throughput is this, and like, what? But if you go to your servers and you're like, hey, when you're ringing up these transactions, yeah, when you're doing your point of sale, and you could just do quick math like, hey, how much am I doing per hour? Then you'll know whether or not you're on track or not. Does that make sense?
It's not really how we talk about it in restaurants or have. It's always like PPA, right? Like how much money we're getting per transaction.
Yep.
Is how I always talk about it.
Yep.
So,
and it's great. And that's one step, like understanding your transaction value. Like that's an important part of the equation. But remember what Michael was talking about at the beginning is volume, right? So you can be like, oh, look at, we're killing it. Like our average transaction value went from like 22 and now we're at 28. And it's like, yeah, you're at 28, but you don't have the velocity. You don't have the volume. So like you're actually worse off from a financial perspective. That's where you have to incorporate the element of time. That's throughput.
I just wanted to say that I appreciate your comment about not treating your labor like liability. That's something that I've had a lot of conversations with friends about. When you're talking about finding ways to make your business more profitable, you don't think about the like harm you do and the like unseen expenses of treating your labor like their liability.
Yeah.
So like finding ways to make more sales rather than to cut serving staff or like take somebody off of the shift.
Yep.
I think more people in restaurants need to hear that.
No, and I think it's such an important concept. You know, unfortunately, people don't go up on the balance sheet as assets. You know, we only record our, we record our appliances and our walk-in coolers and like, all of our FF&E, our fixtures, furniture, all the stuff, right? That shows up on our balance sheet as an asset, but all our people land on the income statement as an expense, right? But it's like so backwards looking. Like we'll buy a piece of equipment, like a $50,000 piece of equipment, and we'll like pet it and polish it and talk nice to it. And you're like, dude, you just dunked, you just made a ding here. What the heck? Be more careful. But then our employees, we treat them like absolute crap. But that's where your return is. That's where your return is, return on labor. Okay, so are you good with the throughput concept? Revenue per hour?
Why are we not considering the people that do the prep and et cetera?
You can. It's going to just lower the revenue per hour, and it's not as useful. So like when I was talking about like the scoopers, like they know their revenue per hour is $100 an hour. That's the target. So like when they're ringing in transactions, like our average transaction value, let's say it's $15 per transaction. An 18-year-old kid can quickly be like, okay, 15, I need to do this many per hour. And we've been dead. Like I've done like 3 in the last hour. And 5 people are sitting around, they could be like, hey, we should probably like send Joey home, right? So they know really quickly, $100 an hour, and they could go into their point of sales, like go into Toast. They could be like, hey, what was our like revenue yesterday? And then divide that by 100, and that's how many labor hours they should be working that day. So when you start including like the cook and you start including like all these other people, the serve, all these, everybody is just going to lower it to like $45 an hour, but it's not super helpful because when you're serving, when you're serving people and then you ring them up and you're like, okay, this is $400. Like, okay, well, I don't know how that equates. Does that make sense?
I mean, I guess I would also say that a lot of those people are not like dependent on your volume. It's like you kind of have to have them.
Yeah.
Like you can't send your cook home or nobody's going to be able to make food.
Exactly.
So it's like that person always stays no matter what your business level is, but the controllable expenses.
Yeah, that makes
sending
sense.
home,
It's
like,
just
yeah.
confusing because we included them in the cost of goods labor.
Yep.
But we're excluding them here, so that.
Yeah. So
To me, it's like who can affect change for an actual transaction,
yeah.
right? So that's bartenders and servers, right? So if we were like, hey, we need to sell more in an hour, the chef does have some input in that, but it's really like the people hustling out here that would affect the revenue per hour. Is how I'm seeing it.
Yeah, that's a good ad. That's a good way to look at it. In your business, like you may like take this and tweak it just slightly. Maybe like, Steve, I'm actually going to add this person in. That's fine. Just whatever you do, just make sure it's consistent. And to Derek's point, it's something that you can manage, right? Something you can improve on.
Seems like also a good way to get to know your servers and your staff and see who you need to kind of focus on and be like, hey, what you're selling per hour compared to everybody else on a typical day. We need to work on this because it's an easy way to kind of see that and help work with that.
Yeah.
With your staff. Otherwise, sometimes you don't know because you're not there all the time, so you don't know how they're engaging with their customers and stuff like that.
Yeah, and that's what we started doing is we have all the scoopers listed out, right? And we have their throughput, and we have their like average transaction value, and we have their throughput. And so then it's almost like a contest, and we post that. And so you see like this, like these people are like super high. These are the rock stars, and then these people are struggling down below. And then what we do is that's part of our culture is we mentor them. Like that's the whole thing. Like Paul's all about the owner of Little Man. He's all about like mentoring and coaching and helping people. So instead of posting and being like, you're terrible, like shame people, make them feel really bad, it's an opportunity to be like, hey, look, like when you're scooping, do you say, hey, do you want this in a waffle cone? And just that suggestion right there, maybe, sure, yeah. And you may get 50% more people saying yes to that, and that's $2 per transaction, right? So there's ways to just like improve your average transaction value and your throughput just by like measuring what matters. Okay.
Does this example apply for like, restaurants like ours, kind of more fast casual? We have, everybody that works in the front, or runner, busser, cashier, they all take turns taking orders, running, bussing tables, trying to upsell the table. Then we have all the bartenders who are just making the drinks, selling the food, doing the full service at the bar. But then come like a busy night or weekend, we have one dedicated cashier taking all the transaction from the entire dining room. And then everybody else that's not bartender or servers are just bussing.
Yeah.
So in an example like that, how would this apply?
So in an example like that, you may say, okay, maybe the whole team is just involved. It's like this orchestration of labor. Then you can say, okay, let me just calculate my throughput, my revenue, divided by all the labor hours that night. And you can just start tracking that. And then as time goes on, you may be like, hey, let me get more precise. And let me just eliminate these people that don't matter like as much as far as the delivery of the product. I'm going to eliminate them from the denominator, and I'm just going to like narrow in my throughput. So for some companies, like for starters, I'm like, okay, if that's too complicated for you, going back to the previous comments, like, okay, let's just take your sales, divide that by all the labor that worked that day. Just start with that. Start measuring that, and then you could start eliminating people from that calculation and fine tune it as you go along.
Yeah,
Does that make sense?
I think you could do it by like weekday and weekends, right? So find that average for Friday, Saturday where you guys are getting crushed, and then just do like a weekday average, and then times each of those by 50, right? And then you can get closer. I mean, it doesn't sound like it's going to be an exact number, right, Steve?
Yeah, it's just a range, and it varies. Like your throughput, your revenue per labor hour is going to typically be lower on a Monday, Tuesday, Wednesday, Thursday, or Monday, Tuesday, Wednesday, or Sunday, whatever it is. And then your throughput is going to be higher on the weekends. And then so you have that variability, but then you also have the seasonality. So you're like, okay, but January through March, it's lower, and then it's busier here, right? So it varies. We just have one number across the board, but then we set targets based on that variability. And it is general. We're not like, okay, your throughput is like $101.15, right? It's like, hey, it's about $100. And so like use that when you're scheduling, use that when you're like managing your labor, and just use that to be like, okay, we're on track or we're off track. Cool? Because remember, your financials are delayed. So like the last thing you want to do is like make a decision 3 weeks later after your financials are closed. You're like, oh crap, we lost like a ton of money this month. You have to be like agile. Okay. All right, is this helpful? Is this good? Okay. So let me show you how the financial statements all fit together. Because you know what's crazy is like I did my undergrad in accounting, and when I got out, like I got my degree, but I was like, why didn't anybody ever explain this to me this way? Like I have my degree in accounting, I don't even know how the financials fit together. And then later on, I was like, okay, geez, they could have made it like so much simpler. So let me explain. So there's 3 financial statements, and there's 3 sections of each, which is like great, because 3 is my lucky number here. And so I'll just make it very easy, the 3 and 3. So first we have the income statement, the balance sheet, and we have the statement of cash flows. Those are your 3 core financial statements. All right?
Sorry, what's the first one?
The income statement. Income statement, profit and loss. Yeah, it's the same thing. So on the income statement, remember I gave you those 3. What are the 3? Do you remember?
Revenue, costs.
Okay, revenue. Yep. Rev, COGS, and your OPEX. In between here, we have our gross profit, and then here we have our operating income or operating profit. Pretty simple? Okay. The balance sheet, on the other hand, is broken into 3 sections, and we have assets, liabilities, and equity. Those are your 3 sections. This is also the accounting formula. Assets equal liabilities plus equity. That's how a balance sheet balances. I'll give you examples. We'll go through these in more detail. The statement of cash flows, we have cash from operating activities. We have cash from investing activities, and we have cash from financing activities. Those are the 3 sections on the statement of cash flows. The most common financial statement in business is the income statement, which is a good place to start with, but in a lot of ways, it's the least effective at telling the true story of the business. So 70% of companies that go bankrupt are actually profitable when they close their doors. 70%. They have profit on their income statement and they go bust. And the reason why is because they're not paying attention to cash flow. Big difference, which I'll explain. Some companies, they have a balance sheet, they never really look at it, and then most companies don't even have the statement of cash flows. So here's the deal. The income statement and the balance sheet, they're lovers. They fell in love here. This is my heart. They fell in love and they had a baby. And this baby right here, which I always say is my baby, is the statement of cash flows. And the reason why I use this analogy is because here you have revenue, cost of goods sold, operating expenses, operating income, other stuff, and you end up with net income from the income statement. You have net income. Guess what? The statement of cash flows starts with net income. So everything from here starts right there. It's just summarized on one line. Then all these changes on the balance sheet between accounts, all those changes show up in these sections, and then you get to, at the end of the day, you get to cash. So you get your change in cash, and then you have your ending cash. And this cash ties back to the balance sheet. So the income statement and the balance sheet are just merge them together, and you get the statement of cash flows. You're not going to get balance sheet stuff on the income statement. You're not going to get income statement stuff necessarily on the balance sheet. Little caveat, there is incomes down here in equity, but other than that, these are pretty distinctive. Combine them together, you get the statement of cash flows. All right, so at a minimum, if you're not looking at the statement of cash flows, that's fine. Just look at the income statement and the balance sheet, okay? Please. Because that's where the balance sheet has your hidden demons.
So we have a bookkeeper who gives us the P&L and the balance sheet. Can we request for that statement of cash flow?
Yeah.
Or is that something that we need to figure out on our own?
What system do you use? Is it QuickBooks? 365, R365. R365 and QuickBooks, like, I know like QuickBooks, like we get into R365 and it's so difficult and nuanced to produce a statement of cash flows out of the system. Same thing with QuickBooks, they're kind of like embarrassed of the statement of cash flows. Like if you look in QuickBooks, you go to reports, it's like income statement, balance sheet, it's like income statement by month, by customer, by, and they give you like all these options. The balance sheet's like balance sheet by period, by this, you know, and then it's like the statement of cash flows is like over here. Go down here to other, to this, and no, I'm just kidding, but they like hide it. They're like, we're embarrassed of this thing. So they like have it, but like I would not rely on it. So in that case, I would extract what you need off here, off the balance sheet, and I'm going to show you how to extract what you need off here to tie it into cash flow.
Honestly, like I never open the balance sheet. I don't know what I'm looking at sometimes.
Okay.
To be honest, I open it and then I close it.
Okay, and that's fine. That's what most people do. Yeah, at least you're looking at it. When I was running my business, I was like, I don't even look at that stuff. Yeah, I just care about profit. Okay, so let's talk about, does this all make sense right here? This part? Okay, let me erase this. Let me explain why businesses go bust. All right, and let me explain what you need to pull off the balance sheet. Okay, so let's say we have two businesses. You like my business ideas. You're like, I'm just going to go over whatever's contrary. Okay, so we have two businesses. And we're going to look at just like the profit of both of these businesses. And let's just say they both make 100 G's in profit. Okay? But their sales are different, but their profit's exactly the same. It's 100 grand. And this one earns profit of 10%, and this one earns profit of 20%. Okay, so it's 20% on their sales, right? So in other words, they do $500 in revenue. This one does $1,000 in revenue. So they have to do, up here, they have to do a lot more work, right, to get to the 10%. Here they do less work and they have 20% margins. Which one would you rather have?
B.
Huh? B? Anybody for A? So it's funny, I was just at this conference in Las Vegas last week, and this guy was like up there trying to teach like the financial side, and he's like, which one is it? And people are like, B, and he's like, exactly, it's B. And I'm like, it's not B. It could be B, but like there's something that's missing, but he was just so emphatic, like, oh yeah, it's B. So here's what's missing. There's two things. First, we have working capital, and next we have CapEx, capital expenditures. I'm going to explain both of these, okay? Working capital is the amount of money that's tied up in inventory, and it's mostly inventory because I'm sure you don't have a lot of accounts receivable. Like most companies, they have accounts receivable. They go out and do work for a customer, and then the customer pays them in like 30 days. But I imagine for you guys is cash, swipe a card, whatever, right? So it's mostly inventory for restaurants. That's what it is. So there's working capital, and then capital expenditures. When you go buy like tables, furniture, fixtures, appliances, whatever, that doesn't show up on your income statement. That shows up on your balance sheet. And that's known as capital expenditures, CapEx. Okay? So let me just say, what if this company right here had $50 in working capital and $20 in CapEx? So actually they had $30 in free cash flow. And this business right here had $10 in working capital, $10 in CapEx, and they had $80 in free cash flow. Which one would you rather have? I'd rather have B. I want cash, right? I want cash. I don't want like what's on my financial statement. And this is where a lot of business owners, they're running these companies and their accountant gives them the income statement and they look and they're like, oh, okay, we made like 150 grand last month. And then they look at their bank account and they're like, I don't know where the 150 grand is, right? I have 10 bucks in my account. And I just drew on our line of credit to make payroll. Like, where is this magical profit that you're showing? So when current assets go up, you have less cash. So if you're looking on your balance sheet and you say, okay, here's my current assets this month, here are my current assets this month, and it's higher, you have less cash. If it goes lower, you have more cash because you depleted your inventory, you sold your inventory. Okay, and then with your current liabilities, it's mostly accounts payable, AP. That's what you owe your vendors. So if you go and buy a bunch of supplies with your vendors and like, cool, you could pay me in 30 days, then that increase, if this was 50 and this goes to 150, if this increases, you have more cash. Let me say that again. When current liabilities increase, you have more cash. Because think about it, you're sitting on your vendor's money. Right? Because they invoiced you, you're sitting on their cash, you haven't paid it yet, but it's sitting right here. Now, accounts payable, payroll liabilities are going to sit in current liabilities. Be watching for that because you're like, sweet, we're sitting on all this cash. It's like, yeah, but you actually owe the IRS here in 15 days, $30,000. Okay? So when current liabilities increase on your balance sheet, you have less cash. When they go down, you have more cash. Sorry. When accounts payable, when current liabilities go up, you have more cash. When they go down, you have less cash. When current assets go up, you have less cash. This making sense? All right, so now, and this is something important. This is something you could do with your team right here. Just take like, this is a quick little lunch and learn or whatever you want to do with your team. But you could give them this example here. And this is important to understand. Let's just say we have a receipt. This is our receipt. And on the receipt, we have cocktail, and we'll make it 20 bucks, okay? Next, you have a tip, $5. They also bought a gift card for $25. They also bought a t-shirt for $20. And then there's taxes on all this. We'll just say the taxes are, I don't know, 10 bucks, whatever. Okay, so we have $25, $50, we have $80. They pay here with their Visa, XXXX, right? And there's your receipt. Okay? How much cash is how much cash does the company actually earn off this transaction right here? Forget about merchant fees, but like how much of this is the company's to hold? Huh?
$45.
$45. Okay, where did he get that from?
Gift card liability and taxes.
Yep. So taxes right here. Where does that go? Income statement or the balance sheet?
Balance sheet.
Yeah. So taxes, the $10 that you have, you collected it. You have to submit that, right, to the agency. So that goes to the balance sheet. T-shirt, 20 bucks. Where does that go? Income statement or balance sheet?
Income statement.
Income statement as revenue, right? Where does the gift card go?
Balance sheet.
Yep. This right here goes to the balance sheet because it's a liability. Thank you, sir. It's a liability, right? So you haven't earned that money. That's not revenue until they use it. Where does the tip go? As the balance sheet, right? That's a liability to your employee. And then the cocktail right here goes on the income statement. So actually what you earned was $40. That's it. Not $80. Now take this, multiply it by thousands, and then now you have the complexity of a business. And you have the difference between profit and cash flow. So you have $80 going into your account. Okay, maybe it's like $73 after merchant fees, whatever. But you have money going into your account, but it's not yours. So if you're running a business or if your employees don't understand this, they're thinking like, oh my gosh, the owner's getting like so rich off me, you know? I'm getting paid like $20 an hour, and they're making like hundreds of bucks an hour, you know? But they don't understand this. So like doing this exercise with your team would be like super helpful. But that's the difference between the income statement and the balance sheet. And all these changes in things, because tip, guess what? This is a current liability. Gift card, that's a current liability, because it's anything that is current on your balance sheet is like due and payable or collectible in 1 year. That's what current means. So this is current, right? This is current. So that's what I'm talking about. All those changes in your current assets and current liabilities make up your working capital. Follow? Working capital is like, can be so confusing. Even sometimes it hurts my head. I'm like, what the heck? It's like it goes up and goes down and this. So that's what I'm talking about there. So going back to the income statement and the balance sheet, we're gonna have lunch here pretty soon. I think it comes at 12:30, right?
It's gonna get here at 12:15.
Okay, cool. So I think it's coming. I see it out in the parking lot. So we'll break for lunch here in a minute. So we have, remember, profit. Grab this off your income statement. This is your income statement. Your working capital, pull this off your balance sheet. And this is your current assets minus your current liabilities. If you have an accountant, just have them calculate this for you. There's your working capital. And then your CapEx, your capital expenditures, is going to come off your balance sheet. But you're going to have to do some math, because on the balance sheet, it's all the stuff you buy accumulating, right? So you have to look at the change period over period. And this, I'm simplifying here, gets you down to cash flow. Yep. Yeah, you want me to say it again? Yep, totally. So your profit is going to come off your income statement right here. Your working capital, you're going to look at the difference between your current assets and your current liabilities. There's going to be a change in those period over period. And then your capital expenditures, this just represents the stuff you're buying, like, you know, furniture, or you buy computers and you capitalize it, or whatever it is. That's recorded on the balance sheet. You have to account for these expenditures. And you take profit minus your working capital minus your CapEx, and you arrive here at your cash flow. So when I work with companies, I'll come in here and I'll say like January, February, March, April, May, June, and I build out a forecast like 36 months out in the future. So if you don't have like a budget or a forecast for your business, this would be a really good step. So having like a forecast going out for the next like 36 months. Now, out here in the future, 24, 36 months down the line, totally inaccurate, right? But like at least you have your numbers like trailing. What most companies do is like, okay, we need to create a budget for this next year. And a lot of times they don't even have a budget, so they're just like, this year's gonna be different. We're gonna create a budget. And then they create a budget, they don't finish it by the beginning of the year like they want to, it rolls out in like February or March. Then they have this budget, and then they think like, okay, this is the budget, it goes through December, we're gonna follow this budget. And somehow just following the budget is gonna make money. It doesn't really work that way. So instead, I like to look at the forecast and have it rolling. Because I want to be like, okay, 24 months out, if I hire somebody back a house and I plug them in $70,000 in January, what does that look like impacting me going forward, right? So in here, we have this forecast, and I have revenue, cost of goods sold, down to profit. And then I go all the way down to cash flow. And what I find oftentimes for businesses is like, okay, January, we had 50 in profit, we had negative 30 in cash. And then for February, we had 10 and we had 20. And here we had 100 and we had negative 60. And that's what it looks like. So you have like a profit number and then you have like a cash flow number. This is what you feel though right here. That's what you're feeling as a business owner. That goes back to what I was talking about. We're like, what the heck? We're showing 100, but like I have $10 in my account. Helpful? Not helpful? Too deep?
No.
Okay.
Let me ask you a question. Maybe.
Yeah.
How many of us who are running these businesses have the ability over time to do this?
I know.
And how realistic is it, or is it someone you need to have someone on the admin side having you do this?
I think it's like, to me, it's creating the tools. It's like, okay, what are the tools I need to run my business? And then like, I don't think you need to have all these tools and make it super complex. I just think it's like, okay, you need a financial forecast, right, for your business. You need to have key performance indicators. Like, what are the 3 to 5 things you're going to just measure, right? Have those. And then the financial reports you can have, those you already have. So just have those. And then it's following the system. But like, if I said to you, okay, how much profit are you going to earn in March? And if you're like, I don't know. And if I said, okay, how much do you do sales per server? I have no clue. What's your cost of pour? Like your pour costs. What are your pour costs? It's like it's so hard to improve anything, And I'm not. That's not to shame anybody in here, because like, trust me, like I said, when I was running my business, I had none of that stuff. I was just like, go out there, do work, get work, do work, get work, do work. That's all I did. And when I look back, I'm like, oh my gosh, if I would have just changed my pricing by 2%, I would have walked home with like 250 more grand. But I didn't. I was just like grinding.
Do you have a program that you recommend? Like, I've mostly used LivePlan for like forecasting, and it's easy to see cash flow and things like that. And in my experience, it's been pretty easy to like, you can make adjustments as you're going and be like, hey, what if my labor goes up by 1%? How does that look over? Like, it's pretty affordable and it's pretty easy to use.
Yeah.
I was curious if you have like a software that you use, or
yeah, in fact, what we just use Google Sheets. Like, I used to use Excel, but Excel, you can't connect it to other sheets. Like, there's some capabilities there, but then with sharing, it's like, hey, here's the budget, and it's like, oh crap, I forgot to add this. Then you resend the email, you're like, here's version 2, don't look at version 1, and then they send you version 2 and you're on version 3. It's like a mess. So we started using Google Sheets just because it's like live, and then you could connect the sheets together, so you can have like this cell equal this cell, and like they reference each other's sheets. So that's what we do, is we just use Google Sheets because it's simple and it's easy to access. But yeah, I'm sure there's other software out there that makes it easy as well to do.
We use, for the markets, we use Box. I don't know if you guys have ever heard of Box. It's like how
BOX?
BOX, yeah. And it has, so what it does is it kicks you out. Like, you could do the same thing with Excel, and then you could do Excel online. You don't even have to like click into the actual thing, and it just takes you to a window, and it automatically uploads back in Box.
I was meaning more like
actual software.
Forecasts.
Yeah.
Like,
Okay.
if you're actually trying to build out like a business plan of like, how much money do I need? What are my expenses? Like, LivePlan's pretty cool. It lines up exactly like a P&L. There's
Which
balance
one do you use?
sheets. It's called LivePlan.
LivePlan?
And I've used it for a handful of like companies that I've either done consulting projects for, or like for our new bar. And you can, once you open, you can keep, updating your budgets, and it'll show you how you're gonna look at the end of the year. But yeah, you can like mess with the numbers all you want. It's like, what if I did another $100 in sales every day? What if I raise my prices by $1, and you can kind of see what the results are. And in my experience, it's been pretty easy. Maybe it's like $30 a month or something.
Thank you.
Yeah, tools like that are great. Like, I would just say, like, R365 has a budgeting module, and so does like QuickBooks. The problem with those is that you go into those systems and you input your budget. So you literally go like line by line. You're like, here's my revenue, and then it's like, okay, going back to Sean, right? Yeah, Stuart, sorry. Going back to Stuart's point is like, okay, what if we raise our prices by $1.50? Then it's like, crap, I got to redo my entire budget. It's not dynamic, right? Like LivePlan's more dynamic.
Yeah, I think so.
So
it's pretty easy.
Thank you.
Yeah, totally.
But yeah, I just say like the biggest thing, like if you're leaving here today, I'd say number one, get a forecast. Like build out the forecast and get not just down to profit, get down to free cash flow. That's like key. And then after that, like make sure you're looking at key performance indicators, which we'll get into. So you just have a quick dashboard and you know some things off the top of your head. And then the next level is having your financial statements. That's like the appendix, the nerdy stuff, right? But like a lot of our teams, they have KPIs and they know exactly what the numbers are. So if I walked up the street to Little Man and I went to the GM and I said, hey, what's your average transaction value? He'd tell me, he'd be like, oh yeah, it's like $14.75. I'd be like, what's your throughput over the last 30 days? He'd tell me, like, number of transactions, average transaction value, revenue per hour. Like these things, they know. They don't need to get into the income statement and the balance sheet, but they need to understand, like, how do we measure success in the organization?